All right, welcome. The Fed, they just flipped a massive switch on the economy. And you're going to want to pay attention because your financial future is kind of hanging in the balance here. We're about to break down a policy shift that is so big, it's really the end of one economic era and the beginning of a whole new one.
So, that brings us to the big question on everyone's mind. Are we looking at a massive housing crash or something else? An inflation boom? Because the answer here, it actually runs completely opposite to what you might be hearing about an impending market crash. The real story, as we'll see, isn't about collapse. It's about inflation.
So here's what we're going to cover. We'll get into what the Fed is doing, exactly why they're doing it, and what it all means for your wallet. We'll look at the impact on mortgages, the long-term picture for home prices, and we're going to debunk some major myths along the way. And then we'll wrap up with a playbook for how to navigate all this.
Okay, let's dive right in. To really get what's going on, we have to look at the mechanics of this shift. The Fed made two huge moves that pretty much set the stage for everything else we're going to talk about. This is where it all starts.
Okay, first up, the thing that got all the headlines, another interest rate cut. One cut could just be a fluke, but two in a row? That's a pattern. That's the Fed basically screaming from the rooftops that we're in a new easing cycle. Borrowing is about to get cheaper.
But here's the thing, that's not even the real story. The much bigger deal, the move with multi-trillion-dollar consequences for the economy, is the end of the Fed's tightening program. This is where it gets really, really interesting.
All right, so let's break this down because it's super important. On one side, you have QE, quantitative easing. You can just think of it as money printing. That's when the Fed is pumping cash into the system. On the other side, you have QT, quantitative tightening. That's the opposite. They're pulling money out to cool things down. So by ending QT, the Fed has stopped taking the punch bowl away. And that's always the first step they take before they start pouring more punch back in. The money printer is basically warming up.
Which leads to the obvious question, right? Why the sudden 180? A central bank doesn't just pivot like this for no reason. There's something big going on behind the scenes.
Well, it turns out there are basically three big reasons. The first two are the official ones you'll hear them talk about, jobs and inflation. But that third one, that's the one that points to a more cynical, and let's be honest, probably more realistic view of just how fragile our financial system really is.
So the public story is that they're scared of tightening the screws too much. They're seeing some really alarming cracks forming in the labor market. All the key signals, hiring at small businesses, announcements for layoffs, they're all pointing in the wrong direction and fast. So the Fed's trying to get ahead of it before they accidentally steer us into a nasty recession.
But then there's this other interpretation. This theory suggests the Fed isn't just reacting to the job market. They're playing chess. They're getting their pieces in place because they know something. Somewhere in the financial system is about to break and will need a massive bailout.
And to give you a sense of the scale of what could break, look at this number. We're talking about $1.5 trillion in commercial real estate debt that's coming due soon, and it has to be refinanced at today's much, much higher rates. The math on that, well, it just doesn't work. It's a time bomb.
In that commercial real estate debt crisis, that's just one of the potential triggers. You've also got these fragile regional banks that are still sitting on huge paper losses from their bond portfolios. And of course, a big drop in the stock market could just wipe out household wealth overnight. Any one of these things could be the domino that forces the Fed to fire up the money printer and unleash another massive round of QE to save the day.
Okay, so what does all this high-level Fed talk actually mean for you trying to buy a house? Well, you've probably noticed that after almost hitting 8%, mortgage rates have started to come down. Let's dig into exactly why that's happening. First things first, let's get one thing straight, because a lot of people get this wrong. The Fed does not set the 30-year mortgage rate you see advertised. Nope, that rate is actually tied to something else entirely, the yield on the 10-year U.S. Treasury note. That's the real benchmark for long-term loans.
So here's how it actually works. It's a chain reaction. Step 1, the Fed pivots and stops QT. Step 2, that means there are fewer government bonds being sold on the market. Simple supply and demand, right? Less supply, plus the signal that the Fed will soon be a huge buyer, means bond prices go up. And here's the key. When a bond's price goes up, its yield goes down. That falling 10-year Treasury yield is what drags mortgage rates down along with it. It's all connected.
And that's the chain of events that brought rates down from those crazy highs near 8% to something closer to 6%. It's what brought a lot of buyers back off the sidelines and gave homeowners a chance to think about refinancing. But, and this is a big but, the key word here is window. This isn't permanent.
Right.
This window of lower rates isn't going to be open forever, which brings us to the long-term forecast, and that is asset inflation. You see, the very same policies that are pushing rates down today are, by their very design, inflationary.
The basic idea here is really simple. When the Fed creates trillions of new dollars out of thin air, that money has to go somewhere, right? It floods into the financial system and it starts chasing assets. And that drives up the price of anything that's scarce: stocks, gold, and especially real estate. This, right here, is the main reason a 2008-style housing crash is so unlikely.
And in a world like this, the whole reason for owning a home starts to change. It's less about a quick flip or a short-term investment, and it becomes more about protecting your wealth for the long haul. Think of it like a lifeboat in an inflationary storm. Real estate is a hard asset, so as the value of the dollar goes down, the price of that hard asset, your home, has to go up.
But, and this is the really tough part of this new reality, there's a dark side. Your wages, they just can't keep up with this kind of asset inflation. Think about it. If your paycheck goes up by 4% in a year, but the house you want to buy goes up by 15%, that gap between the people who own assets and the people who earn wages becomes a massive canyon.
And this growing gap, it's effectively creating a permanent renter class. It's locking an entire generation out of homeownership. The American dream is being systematically dismantled. You end up with a two-tiered economy. You have asset owners, and you have wage earners. It's a modern form of financial feudalism, really.
Okay, I know what a lot of you are probably thinking right now. This all sounds like a giant bubble. I'm just going to wait for the 2008-style crash. But it is absolutely critical to understand why this time is completely different. The comparison to 2008 is just fundamentally wrong.
I mean, this table really tells the whole story. Look at every single important measure. Today's market is the polar opposite of the subprime crisis. Back then, you had borrowers with mediocre credit scores getting risky loans with practically no money down. Today, borrowers have excellent credit and conservative loans. Back then, you had a huge glut of houses for sale. Today, we have a chronic shortage. It's just not the same.
Yeah, the borrower in 2007 was a ticking time bomb. Today's homeowner is more like a financial fortress. They have great credit, stable, fixed-rate loans they can actually afford, and most importantly, they're sitting on a mountain of home equity. They have no reason to walk away from their homes. A wave of foreclosures like we saw back then, it's just not in the cards.
So, if a crash isn't coming, what's the move? How do you actually navigate this new normal? Let's get practical and talk strategy.
All right, depending on who you are, there are a few clear plays on the board. If you bought a home recently with a high rate, your play is to get ready to refinance in this window of lower rates. If you're an investor, it's an acquisition play. You're looking for motivated sellers, like house flippers who got stuck with high-interest debt. And for pretty much everyone looking for long-term wealth protection, there's the landlord play, buying rental properties as a direct hedge against the inflation these policies are creating.
So when you put it all together, the Fed's pivot isn't steering us toward a crash. It's steering us directly into a policy-driven surge in asset prices. The outcome isn't a sudden collapse, but a slow, relentless inflation that prices out an entire generation. And that leaves us with a pretty heavy question to think about. What kind of economy are we actually building here? Are we heading into an age of financial feudalism,